Hey, everyone. Thank you for waiting. I think that gives enough time for everyone to join. You're very welcome to this presentation today, investment presentation. My name is Robert Whelan. For those who don't know, I am portfolio manager with NCB Cayman Capital Markets. And as I said, you're very welcome to this webinar. I think the best place to start is just why we hope that you can get out of this. And firstly, I would say hopefully you can get a better understanding about what's happened in the investment markets over the last 5 to 6 months, especially around what's happened with tariffs. Secondly, would be to give you our investment themes that we think will work in the markets over the next couple of years, especially with Trump in office. And thirdly, just to, I would say, reiterate the importance of having a plan when investing. I know it sounds simple and basic, but given what's happened over the last, especially in April, markets were down about 20%, that you stick to your long-term process. And of course, that's what we're here to help with, to get your time horizon right, get your risk objectives right. People always have a plan of what they want to do in the long term, and then their portfolio is down 20% and they want to sell and they want to get out. So it's really important to stick to that long-term plan, and we'll go into reasons why that is later on in the presentation. So let's jump in. So agenda, just we're going to run through quickly. We're going to go through year-to-date performance. We'll look at the tariff sell-off of April I talked about. We'll look at the supposed experts' view on what has happened. We'll look at tariff basics. Of course, everyone is coming at it from a different level of experience. So let's touch on a few basics. We'll talk about Trump's wider policy, and we'll also talk about opportunities and risks for 2025, and then we'll do a question and close. So I would just say to start off, apologies. Put your questions in the chat if you have any questions. I'll look to try and answer them at the end. This presentation is being recorded, so a lot of our clients have asked to send on. So please send me an email if you want either the investment slides or you want a copy of the recording after this. So year-to-date performance, we would say the first three indices here, I would just say S&P, NASDAQ, Dow Jones. These are all the US-based indices. It's a collection of the largest stocks in the market. We can see on a year-to-date basis, they're kind of flat year-to-date, haven't really done much. Whereas the likes of Europe has done very well. It's up around 20%. China also up 17%. I mean, the reason why Europe firstly is up is it's kind of been seen as a safe haven market away from possibly the erratic Trump policies that we've had. And people see that as the next best alternative to a developed market and a place to invest. China, on the other hand, they possibly are turning around their economy. There has been problems around, they have tried to deleverage their housing market, deflation. There's been worried consumers about, the consumer has been worried that therefore they're not spending. But the government has started there. The Chinese government has started to spend a lot more money in terms of stimulus, helping out the consumer, helping out the property sector. So that's why I think we've seen a good performance for the start of the quarter. But I mean, look at these drawdowns. That speaks to the tariff, especially in the US, the tariff news. China 25, US, in the 20s, almost in the high teens, and that's really been all because of tariffs. But I think it's also important to look at the 5-year annualized returns. We can see that if you invest in the S&P, you would have made 16.5% per year over the last 5 years. So Europe has done okay. China has been flat. I mean, if you invested in China over the last couple of years, you would have made any money at all. Well, no money really. But we do think it's a high risk, high reward market. There is possibilities here, and we'll talk about it later as we go into the presentation. So we'll talk about the US market first, because that's the market that most investors invest in, and the tariff impact that we've had. And what we're looking at here is the S&P 500 from 2023, or well, back last 5 years. What's important, I mean, 2023, 2024 have been excellent years for the market. They were up basically 20% in 23, 20% in 24. But as we came into 25, we've had this big pullback in markets. And April 2nd was known as Liberation Day, what Trump mentioned. It brought in the tariffs. Those reciprocal tariffs that we saw was probably worse than a lot of people thought they would be. And I mean, if you invested in the market at this high, I mean, at the start of 2025, by April, let's say you invested 1 million at the start of the year. In April, you were looking at your portfolio that said 800,000. So almost 800,000. So there were big moves. And just remember that this is just at the index level. Below it, there's a lot of stocks that did a lot worse, or they were down more. They were down 30, 40%. So what we did see, though, is quite a big snapback rally. And I mean, at the time, people didn't think that would happen. A lot of people thought markets were going a lot lower. And the reason really for this rally was all based on Trump announcing the 90-day reprieve or from this tariff implementation, give people time to invest, or give people time to make deals and possibly avoid the kind of the heavier tariffs that we saw at the outset. So experts, they get it wrong too. And I have to maybe make mention to this character. Maybe some of you might know him by the name of Jim Cramer. He's always on CNBC, financial news contributor. He said, now go back here, we say April 2nd, we had Liberation Day, tariff announcements right here at this point. Market kind of fell apart, was down about 10% over that week. He said on April 4th, so basically 2 days after that, Jim Cramer warned of a 1987 Black Monday style market crash. So just what happened on Black Monday in 1987? The market fell 22% in 1 day. And that's what he was saying was going to happen after Trump announced those tariffs. And lo and behold, a month later, if you saw since that comment, just over a month ago, the S&P is up over 16%. If you sold on April 4th, you missed out on some of the greatest 1 month gains ever. So look, a few examples here. Amazon was up 24, Meta was up 30, Netflix was up 33, Microsoft up 24. So really, the point here is that when there is this type of a market crash, listening to financial news media, I mean, they want to sell their articles, they want to sell their media pieces, their sound bites, and it's probably not the best things to be listening to because they're selling fear. And it just the same way as if the market was at all-time highs, you'd hear, oh, you better get into the market now. It's at all-time high. It's going higher. Everyone else is making money. You're not making money. So they play off those emotions. And as we as investors have to focus on our process and our what's right for us, our objectives, our time horizons, etc. But it's not just, I mean, it's not just the media. It's also, we look at Ray Dalio here, who's a very famous hedge fund manager. He said the US will experience something worse than a recession due to trade policies. So I mean, what's worse than a recession is a depression. It's what we had back in 1929. And he thinks that's what's going to happen. And that's why I go back here and said people thought this was going to get a lot worse. So the main point is it's always important to stick to your own plan. And what I mentioned here is probably one of the most important things that I will talk about today, not regarding tariffs. And it's this time in the market versus timing the market. Many people know it. I've heard of this phrase before, but just to put some figures on it to help you understand it in a better way. The returns, what we're looking at here is the returns of the S&P 500 between 2003 and 2022. So 20-year performance goes over the great financial crisis. And what I hear a lot from investors is, Rob, the market's going down. I'm going to get out now and I'll get back in when it's going up, which is sort of a flawed logic because nobody, not even the Ray Dalios, the Warren Buffetts of the world, can really time the market, as we say here. Could they sell here and then buy back in here. No one can really do that. So it just kind of pays to stay invested. And this chart kind of explains it. If you invested 10,000 in 2003, fully invested, you would have made 9.8% over that period. And that's including all the drawdowns that happened in the great financial crisis of 2009. But if you missed just the 10 best days, and now that doesn't sound like a lot, the 10 best days, your returns over that period would have been halved, which is amazing, really, when you consider that it's only 10 days. And the reason for that is in this box, in this red box here, 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So if you get out, as we saw on the chart, if you get out, you sell down at the bottom here, say, "Oh, get in when the market is back up." It's back up around here. Look at what this is on the just on the S&P. So you've gone from 5,000 to 6,000. That's at almost a 20% move that you've missed out on over the space of a couple of days. So there's some days in the market where, I mean, there's really big performance. And if you're trying to get back in here at the top, you've lost all those losses that you made. And we can see from the chart here that it makes a difference in the long term. And of course, if you go longer than 10 days, you can miss, your returns are even worse. So of course, it's not always, I mean, always 9 times out of 10, this is the playbook. Of course, if you're retiring next year, you're going to be taking off risk. You're not going to be in the situation where you're fully invested when you're hitting retirement and you need kind of more security with your assets. So what's going to lead us lower or what's going to lead us higher? In my opinion, it's all going to be based on tariffs. And although, as we saw on that chart, we've recovered a lot of those losses already, what happens from here will depend on tariffs, in my opinion. And I mean, just the basics on, I mean, what is a tariff to start off with? A tariff is a tax on goods imported, like clothes, cars, into a country, which raises revenue for the government, in this case, the US government. So it's actually, when you think about it, it's the US government taxing its own businesses, which is not understood by many. And yeah, so it's that tax that's in place. And I mean, what is the usual impact of that? If we want to give it the simple answer, it's usually we get higher inflation, lower growth. That's usually the playbook of when tariffs are implemented. And you might have heard something that's called stagflation. Different from inflation, stagflation is that environment where you have higher inflation, lower growth. And it creates I would say, a bit of a nightmare scenario for the Fed or central banks, because it sort of hamstrings them. They can't act, because if they try and say, okay, growth is lower, let's lower our interest rate to stimulate growth. By doing so, you're basically pushing up inflation, so making the problem even worse. So they're sort of in a situation where they can't act until inflation comes down or the tariffs come off. And the last situation we had of this was actually in the 70s. And the Federal Reserve chief at the time was Paul Volcker. And he actually had to raise rates, even though the economy was in a bad situation, to sort of kill inflation. And that would be a scenario that hopefully we don't have to get to. And the other thing then is supply chain. So what happens when you implement tariffs, you get supply chain disruption, possibly like what we had back in COVID. And an example I looked at recently was in Mexico. I saw as a BMW the car company recently built a massive factory. It was 2020 where they finalized the car plant. And imagine you've just after building a plant in Mexico, I say, okay, and you want to serve the US market because that is that's the biggest market in the world, biggest consumer market. And now you have the 20%, 30% tariff on your consumers that you're trying to sell to. So, I mean, think about that across the spectrum. All the businesses that have that problem now. What is BMW going to move their Mexico plant to the US and just demolish the building that they've just built? It's kind of nonsensical. So it is going to cause supply chain disruption. It is going to cause inflation, hopefully in the short term, as we'll go into here, but it could be a long-term problem as well. So this graph, I made up this graph to kind of think about the different options. A simple way to think about it is a US company buying a product from China. The original product cost $100, but with the tariff, it will cost 120. So the option A, first option is the China firm lowers the price, their own price to $80. So the US continues to pay the price that it paid originally. So in this scenario, the Chinese company is taking the hit. They're taking the margin compression hit. And this would only happen in a scenario really where there's really, really high competition, where the US company could say, well, China, we're not going to pay that tariff. We're going to go to another country and try and get our product from another country. But given that tariffs are a worldwide phenomenon now from the US, that is not a totally likely scenario. But maybe the Chinese company wants the business so bad that they'll say, okay, we'll take the margin hit. You continue to buy at this price. And we haven't seen a lot of that at the moment. And really what we've seen mostly is option B here. And option B is where the US company absorbs the tariff cost. They hurt their own margin, but they're able to keep market share in the US. So let's say they bought it in for 100, they now it costs 120. They were to sell it, they were selling it at 200. Now they're continuing to sell it at 200. They take that margin hit just to maintain their market share. And there's two reasons why this is happening at the moment. One is that companies are running down their inventory. So they have pre-tariff inventory that they're using up. There's no tariffs on that. They'll just sell it as is. Or secondly, a situation where the companies see these tariffs as a short term. They look at Trump and say, okay, this is only a short-term issue. We see that deals are getting done. We don't want to lose our market share in the short term here. So what we'll do is we'll take the short-term hit. Now, of course, they're not going to do that. If your margin is only 5% on your business and you have a 20% tariff, 30% tariff, you can't sustain that in the long term. You'll be loss making. And a lot of businesses will have to pass it on to customers. And that's what we're seeing. This is the worst case would be this option C, where the US company passes those $20 tariff onto the final customer. And let's say they were selling it at 200 to the US customer. Now they're selling it at 220. And as I said, that would be the case if customers cannot, or companies or deals are not being get done, or are taking too long to get done. They have to pass on those deals. And we've seen those or why that is so bad, because let me just see here. Give me 1 second. Option C is bad because, firstly, it causes inflation, right? If we have inflation, consumers have less spending money because everything is more expensive. Businesses feel the effect. They don't have as much revenue. Then maybe they have to hire less staff, and then share prices go down. So the main point here is that if tariffs stay in place and we don't get negotiated deals, we could be in option C and it'd be a bad scenario. We're in option B at the moment. We had inflation numbers last week, which show no signs of inflation, which shows that we're in this section at the moment. But this is the worry, and we hope we do get those deals. If we just look at it, historically, how have tariffs been done in the past? I think this is really interesting that tariff revenue in the past for the US was huge. 1800s tariff revenue percent of total government revenue was really large, and it's come down over the years. And I think firstly, let's just look at the 1900s, because that's probably the most relevant period that we have to today's tariffs. And we'll talk about set it up here, but Smoot-Hawley were tariffs of the 1930s. Smoot and Hawley were two Republican congressmen that decided to bring in tariffs in the 1930s. Now, this was just after we had 1929, Great Depression, financial crash. So between 1929 and 1932, the US stock market fell by 89%, which is incredible, really. And they decided to bring in these tariffs as a way of, I would say, trying to support the US economy while this Great Depression was happening. And of course, it actually turned out to be a disaster, because there was actually less growth, and economists talk about this afterwards, say it actually compounded the problem of the depression. And it makes you wonder now, bringing in these tariffs, if it's a good idea. So, I mean, we look back at the 1800s period, it's not as relevant because tariffs were so high then. But the reasons why they declined, I think, is important. They were declined because tariff revenue in the US shifted to income taxes, business taxes, because it was more stable. Obviously, it is cyclical again with the economy, but tariffs is based on trade. You can have one year here we have lots of income, the US government, another year you don't have as much. So that's one of the reasons. Secondly, and really the final nail on the coffin for tariffs was in the 1940s when I suppose after World War II, we had to sort of rise to prominence of the USSR. Um, and that was all led by communism. It was an idea, it was a thought that was working. But to sort of counter that, the US really went fully in on globalization and um, and basically made no tariffs. So let's everybody trade with each other. We're unlikely to have a war with each other if we have to trade. We're trading partners. So that's really what happened. But the question now with a Trump policy is, has it gone too far with globalization? And this is key to understanding everything in Trump's policy. And just a backtrack here and say, I mean, what is globalization? My definition is where people, you start building things or goods are manufactured in the country where they're most efficient at being produced. So, for example, cheap products went to China because they had cheap labor, whereas USA focused on a service-based business. So, according to Trump and his policy, that this idea of globalization has gone too far, and that's why they want to bring back manufacturing. That's why they want to tariff parts of the large parts of the economy. And it was an easy way to see this is through COVID. If you remember in COVID, there was lots of talk about, oh, well, China's making all the medical supplies. We have no medical supplies in our country. Why do we not have any of that? Oh, they're made in China because it's cheap. Same with vaccines. All these vaccines are made overseas, and we don't have access to that. And certain things, according to Trump, they should be made in the US or should be made in the home country for, as what I call, national security is economic security. That's the whole idea around a Trump policy and what he's trying to bring to the table. That's why he's doing tariffs. That's why he's tariffs on steel, cars. I'll talk about that in a minute. It's an interesting one. Tariffs on high tech manufacturing. They all want to bring back certain parts. Not talking about any. I don't. They don't care about car or they don't care about clothes or shoes. They don't want to bring those things back. They want to bring back the high end manufacturing back to the US. And when you see that, it starts to make sense around globalization of why what's termed really reshoring of certain industries, and has that globalization gone too far. And other parts of the Trump policy start to make sense then. I mean, why are they going after a mineral deal in Ukraine? They want resources to power that manufacturing. Why are they talking about Canada as a 51st state? They're saying, hey, I mean, Canada is one of the most natural resource rich countries in the world. They want to bring that into the US system. Same with Greenland, access to the Arctic Circle. They have a lot of resources. And if we look at the chart here, it's just gone too far on the manufacturing front. And I mean, this is not my belief. This is really what Trump believes, and trying to understand that policy so we can invest. China makes a third of manufactured goods in the world, which Trump thinks is too much. And to give you one example, it's good evidence, but China's largest shipbuilder in 2024 built more commercial vessels than the entire US shipbuilding industry has produced since World War II. So in one year, China's made more ships than the US has made since the start of World War II. That gives you just an idea of the level of manufacturing that they're at. And the key point is that the US fears this level of manufacturing. And to give you a sort of an idea of that fear is, for example, China is it overtook Germany quite recently as the leading car manufacturer in the world. And why are they tariffing cars? You think, okay, why would you bring back a car manufacturing base? And an interesting point, I think, is that in World War II, Germany turned all of its car manufacturing plants, Volkswagen, Mercedes, into just producing military equipment. So tanks, armored vehicles. I'm not saying that the US is about to start a war or anything, but they I feel that their manufacturing base has been hollowed out, and they want access. Either if they're building cars now, that can be changed to military equipment in the future, or if needs be. But they fear China has this huge lead at the moment, and they want to rein it in basically. So while the long-term goal really has been resetting trade, it makes you think, and about bringing back that strategic manufacturing, it makes you think, was all this a negotiation tactic by Trump, resetting of those relations, getting better deals for the US? I mean, the long-term goal really is around, I think, is that strategic manufacturing, but the tariffs have been that tool. And an example that I've used with clients in the past is, I mean, I read some of the Art of the Deal by Trump, and it's all about his what he says in the book is all about negotiating leverage, and they know that the US is the biggest consumer market in the world. You have to deal with the US. China cannot sell its products to Europe, cannot take up the difference because the US market is so big. An example I said I've used with clients is that, think about it as you're selling a house. Let's say your house is worth 600,000 US dollars. You're desperate to sell, and me, I'm the only buyer in the market, and I come along and say, right, I'll such and such, I'll give you 300,000 for that house, and you say no, that's a crazy offer. That's what basically Trump has done with the entire tariff policy. He said, come out with a really low blow, really low ball offer, and let's say let's negotiate from here. And to be honest, it's working to a degree. I mean, the UK has made a deal already. There's a starting point of a deal with China. There's major Asian nations, Japan, South Korea, India are all in the running to do a deal. I mean, that's Europe has been slow, but I mean, they're a collective, they're a union basically. So France wants something different to Germany, wants something different to Italy. So that will take time, but they are doing deals, which is good to see. Um, I mean, this is a real question, I think, for most people, is has the market bottomed from this tariff risks? And I mean, I would be of the opinion that yes, it has, with a caveat, of course, on if tariff negotiations take too long. But I think we're looking at another 10% on the S&P towards the end of the year. And I mean, the reasons to be positive. I've put a picture here of Trump with well, he was in the Middle East over, or it was last week. And if you look at his cabinet, just look at the makeup of his cabinet, there's no real career diplomats in that cabinet. They're all business leaders. And that's what Trump has been doing his entire life is really making these deals. And not only from a tariff perspective, also sort of deals with countries. And he did quite a few really in the Middle East. One of the big ones, I just mentioned a few, is kind of arranged a deal, Boeing deal, their largest deal ever with Qatar Airways, 160 jets was purchased. Saudi Arabia said they would invest $600 billion into AI infrastructure in the US, which is huge. There's also other deals around defense and the energy sector. I think it was around $140 billion deal. We saw Trump did a speech where he said he would announce lifting of sanctions on Syria, which will provide a more oil supply to the market. Probably short term, not great for oil companies, but over the long term, it would be quite good because it will provide an extra supply of oil. The economy will keep prices low, which is, I mean, good for the economy. Other sort of reasons to be positive here, I think, is we have this tax bill coming up. I mean, it's changing daily, but it is in the works. You can see it in the news today, even. There was news around proposed tax cuts for domestic manufactured. I mean, what I talked about earlier, bringing the tax rate from 21% down to 15, which would be very, very beneficial to companies. Taxes for citizens. I mean, some of the ones we saw is no tax on tips, no tax on overtime. There's a SALT deduction. SALT stands for the state and local taxes. Basically, if you pay your tax in the US, you get a deduction from your federal taxes, and they're thinking about raising that cap, which would basically mean a tax break for citizens. or less taxes to pay, which would put more money in the hands of U.S. citizens, which would be positive. There's also a lot of talk around deregulation, executive orders, and of course the Fed. The Fed is at the top of their cycle. They're at 4.5% on their interest rate, whereas the inflation rate is at 2.8. So almost you could say that the Fed is at a restrictive point here, and they can support the economy when maybe if the economy starts to slow from tariffs, there's still a lot of room to support there. So which is another positive. So how do you play it, right? What are the ways that you could play this going forward? And these are investment themes that we think will work. Of course, in the US, I've talked about this before in the past. The idea, I mean, people probably heard this a lot from me around AI adoption, cloud computing. I think this is still a mega trend to be invested in. Microsoft, Google, Amazon are some of the big names. I just read the earnings report from some of these big companies what they reported the last couple of weeks, and amazing level of spending that they're still doing despite all the uncertainty we've had in the market, and we can see it here on the graph, right? Every year there's just more and more spending from these big hyperscalers, and of course you're not going to spend in a market that you don't think you're going to get a return. So the fact that they're spending even more makes you think that they see an opportunity. And some of the commentary again was really positive. They're thinking. I mean, and some of the comments they were saying that AI is becoming more and more of an integrated parts of businesses, becoming more useful, more efficiency for businesses means more savings, means possibly less workers, means higher margins, means higher stock prices. So that's really the train of thought there. Reshoring, this is the idea I brought about earlier. Our companies bringing manufacturing back to the US. It's a theme that, I mean, we know NVIDIA, the big semiconductor name, has announced big plans. Taiwan Semiconductor also building back in the US. So the US have control over that AI industry. But not just the companies, and actually the industrial side of that as well, that companies that are helping to build out these plants. We have Caterpillar. I like also Eaton Corporation is another good name. Defense industrial ties in a little bit with reshoring, but also Trump was going to want a strong military. And I just saw on the news there yesterday the talks of Golden, or is it the Golden Dome? It was called. And we know Israel has what's called an Iron Dome, kind of protecting it from missiles from abroad. It's an early warning defense mechanism system. The US wants to build a Golden Dome over the entire of the US. So think about the defense spending there. Think about the AI spending to kind of power that. That's why we believe in those defensive and AI names, and some other names even defensively. Boeing and Lockheed Martin are two names that we like in that space. Financial deregulation is good for not only mergers and acquisition. There's a lot of I think there's a lot of deregulation or bringing down capital requirements for banks, which means it's easier for them to lend. So we do like Goldman Sachs, JP Morgan from that perspective. Go on to Europe. I would say Europe is probably more of a safer market. As I said at the outset, it is away from maybe the volatile Trump policies. It's a lower growth market, but probably more stable, more mature businesses, more safe haven trade. But there is a lot of good dividend names that we like over there. And one of a really key point to bear in mind for dividend investors is that there's no withholding tax on UK dividend investments. So if you invest in the US, for example, you got to pay your 30% tax at source on those dividends. You invest in the UK, the UK companies that are incorporated in the UK, no withholding tax, which is a good benefit for dividend investors. Now, there is a few exceptions. Real estate investment trust, let me know if you're thinking about investing in them. But for the most part, you're kind of saving 30% there. For China's themes, I would say the internet names are the names that we like around the technology space. You can see here there's a graph that China is actually, I mean, despite, I would say, Western media saying that, okay, maybe Chinese technology is inferior, or it's low quality, or it's copycat material. I mean, data that I've been looking at says, kind of begs to differ, that they are leading in some large parts of the technology space, especially around 5G technologies. The US is only really leading in kind of AI, the AI technology space, but China is catching up quickly, and we saw with the DeepSeek back in January how good their AI models are. Anyway, um, and I mean, just kind of anecdotally, I would say, I mean, I was of that opinion as well, that maybe the Chinese tech isn't as good. I was in Spain at the summer for my sister's wedding, and went to the airport, went to go collect a car. I think we wanted to collect a Toyota. Anyways, our flight arrived late, so our car was gone. But the rental agent said, "Okay, we have this Chinese car. Would you like to take it instead?" I was like, "Okay, fine, we'll take it." Um, and I was just surprised by the company. It was a company I've never heard of. Link and Co. Was the name of the car company, and it was amazing. I mean, I could have been driving. It was a 4x4. I could have been driving a Range Rover. Just the quality of the car and the riding experience. It kind of changed my perception, and it kind of backed up by the data. Then again, that China are really getting close to the US in terms of their technology aspirations. So the way we play it is through KWeb, the ticker symbol KWED, KWEB. And it's a diversified way of playing those Chinese tech names rather than there's a lot of risk in single stock exposure. But we do like Alibaba and Tencent as well. But KWeb would probably be the best way to play that. So risks, of course, it's positive, but we have to look at the risks as well. And there is this talk of end of US exceptionalism. And this is the idea that the US is no longer a place to do leading business or invest. And I'd be of the opinion that that is premature in its idea, because although Trump is in office, he's erratic. We've seen kind of volatile moves in the markets. The US is still the energy dominant country of the world. It still has the dollar as the leading world reserve currency. And if you want to raise capital, the US still is the leading place to do it. It has the deepest, most liquid markets, and that's not going away, in my opinion, even with the Trump in office and the sort of the volatility that he brings. As I said in the past, at the start, I mean, if trade deals don't get done, that is a risk. We had that option C. They take too long, or the deals don't get done. That is a risk that you have to be watching out for in the market. If you don't see in the next couple of weeks an India deal, maybe a Japan deal, then it could be that we might want to take some risk off the table. Of course, deficit concerns are always with the US, and you can see here this is a crazy number. You can look this up yourself. It's on usdebtclock.org. And US national debt, $36 trillion in debt, or 323,000 per person. Of course, this has always been a risk that people have used as a risk to markets. And I think we'll possibly see a more conservative tax bill, because this debt is getting to an unsustainable level, and even Jerome Powell has said it's getting unsustainable. Who's the Fed chief of the central bank in the US. So if we do, the way to see if markets will react negatively to this tax bill that's coming up is if bond yields spike. If bond yields spike, or what's called bond vigilantes, that means that they have no confidence in what the Trump administration is doing. And that's basically why they brought in that 90-day reprieve we saw from tariffs, because bond yields were spiking. And that should be your sort of indicator that, okay, maybe again to take risk off the table. But I think it's probably fine as long as the US government or the US economy is growing at a faster rate than debt, then your debt to GDP is actually coming down. So that then it's sort of seen as sustainable, even though the number itself is quite large and scary. Of course, then geopolitical concerns, there's always something that can cause a volatility in the market. And we've seen quite a few over the last couple of months. India, Pakistan. We've seen Israel, Hamas, US, Yemen, Houthis. When the Red Sea, they were firing missiles at ships, and Ukraine, Russia. So we'd be hopeful that kind of Ukraine, Russia will come to a ceasefire at some point. But these are always risk. There's always conflict in the market. We've talked about this before, and we always kind of use this as an opportunity to invest, unless it's the US that's getting involved in a large scale conflict. That would be I think, a warning sign. And then finally, it's just to accept more or expect more volatility. This is a Trump market. There is going to be lots of opportunities, but also a lot of pitfalls to avoid. It is emotional, and it is politically, I would say, charged. A comment I saw, or statement, is leave your political biases at the door when investing in the market. My personal preference is I don't care who's in office. I try and understand the policy behind the president and use that to come up with themes like this to invest. And I think that's the way to try to think about it from a political point of view. It can kind of cloud your judgment. There's investors that are on the, let's say, are on the left or they're on the right, and both are bad for investment. You have to just think about in a logical explanation, a logical way, and which is best for my portfolio, I would say. So key takeaways, I would say, a picture of Warren Buffett here, because Warren Buffett, probably the best investor of all time. He announced his retirement this year. He is at the ripe age of 95 from Berkshire Hathaway, and he's provided so much, I would say, wisdom over the years. And one of the most, I put him in here, one of the most famous is this phrase here. It's be greedy when others are fearful, and fearful when others are greedy. Of course, it's hard to do at the time, but that is essentially how you beat the market. April should have been a time where you say, okay, look around. What is the financial media saying? Are they panicking? They're trying to create panic. That's when you say, okay, if I'm a long-term investor, this is where I buy. And that's really how you can beat the market. That's where, for a lot of clients, we bought in that April period, because we knew they had long-term horizons. Get through this sort of tariff situation, and the markets will be higher in, hopefully in a year's time, but over 5-10 years, definitely will be higher. So please remember that phrase. Know your risk levels also is important. EU is kind of the safe market at the moment, away from the erratic Trump policies. The US is more of a, I would say, middle risk. China is more of a higher risk environment. And then again, just be ready for volatility when it happens, because Trump is a volatile character, and there probably will be some more drawdowns like we had in April over the next couple of months. So have your buy lists ready to go. And of course, we're here to help with that. That's our idea, is to help with you planning the portfolio, setting you up so we can make money, especially when there's these massive drawdowns. So I will leave it there and see if there's any questions. And there mightn't be, but if there's not, that's okay. Let me just see here. Yeah, good question here. On Chinese PEs relative, they're extremely cheap, Matthew. If you look at, they are so different to what they would be in the US, especially for these tech companies. Now, there is risk, right? It's a centrally planned economy, so you have to realize that this is not the level of deep capital markets kind of way of law that you have in the US. There is risk, and that's why I like to play it through K-Web. It's a diversified internet ETF where you get access to the likes of Alibaba, Tencent, that trade kind of at multiples that are at low levels. I would say between the 10 and 20 range, and it's really a very, I would say, a cheap market, but there is risk, and the economy is in a weak position, and with the tariff news as well, that is something we need to be watching as well. So let's see here. Let's see here. What advice do you give companies to reduce the effects of tariffs without passing these costs onto consumers in the US? I mean, there's not really much you can. I mean, it depends on your bottom line margin of your business, right? If your business makes a 10% margin and there's a cost coming in that's in a 20% margin or a 20% tariff on your product that is basically the main thing you're selling, then that's going to eat up a lot of your margin. How can you not pass that on to consumer? I think what it's important to do is watch what a lot of companies are doing right now is I would say they are, as I said, they are holding off on passing it on. They're taking the hit for the moment because they want to maintain that market share. They don't want to say, okay, we'll raise our prices now. Our customer will go elsewhere and then lose that opportunity in the future. So, I mean, there's not really much we can do apart from see what Trump does with tariffs and hopefully there will be a negotiation where they'll get lowered and lowered and lowered over time. Um, but in terms of specifics, I mean, it's very company specific question. Without having the details, that's probably as well as I can answer it. And there's a question that just reminded me of something that happened last week. It might be something that people will be interested in. Is the U.S. debt downgrade that we saw last week, and is that a cause for concern? We saw Moody's brought down U.S. debt or their credit rating from AAA down to AA. And is that a worry? I don't think it's a worry. I mean, it's probably a little bit lagged in its the fact that the S&P 500 or the S&P and Fitch, which are the other credit rating agencies, they announced a couple of years ago that they were reducing the US from the top credit rating down to the second highest credit rating. And I don't see, I mean, the most important thing around that credit rating is that the US can never default on its debt. And maybe people don't realize that that's the case, but they can't default on their debt because their debt is issued in their own currency. They can always print more money to pay off that debt. And of course, that causes its own problem with inflation. If you print more debt to pay off debt, print more money to pay off debt, then you're going to cause inflation. But if that's a worry for you and you think that's a worry, then your options are gold and Bitcoin. Get into something that has a fixed supply. And you can see what's happened with gold this year. The fact that it's done so well is probably a reflection of the fact that U.S. debt has risen so much. And I mean, take the other example is a country like Argentina. They can default on their debt. They've defaulted the most of all time because I think it was 7 or 8 times they've defaulted because they've been borrowing in US dollar or not in their own currency. So they can't just print Argentinian pesos to pay off that debt, whereas the US can. So if that's a risk for you, or you think it's a risk, I don't. I mean, if the U.S. economy grows, it's not so much of a risk. If the U.S. economy goes into recession, and we have this high level of debt, that's a little bit more of a concern. So I wouldn't be worried about that downgrade, as the other two rating agencies have already downgraded over the last couple of years. Uh, if there's no other questions, I mean, there's one other one I would just give you because it's a very interesting stock at the moment is United Healthcare. And I've been asked this question so many times over the last couple of weeks. Probably the second biggest healthcare stock in the market. It's fallen 50% in the last month, which is incredible for a company of that size. And do I think it's a buy here? I mean, it has a PE ratio of 11. I think a dividend rate of about 3%. And there's been a lot of, I'd say there's a lot of negative news have been hit that stock. And I just don't think it's a buy yet. If you're trying to say kind of time a bottom, there's a lot of negative news. There's a fraud story. Their CEO was one of their CEOs of their subsidiary was murdered in New York. You probably saw that in the news the last couple of weeks. There's a saying, don't catch a falling knife. Wait for sort of a bottoming pattern before you try to get in. And that's where I'm in. But I think that could be a long-term opportunity as well. So have a look at that one, United Healthcare. I'm watching that one very carefully. So if there's not any more questions, I'll leave it there and say thanks for joining. Hopefully that was helpful and useful. And of course, if you have any other questions on this presentation, or you want the slides or the recording, please let me know, or reach out by me. My email address was there on the screen. Reach out to one of your team member or your NCB team members. They'd be happy to provide it. So thank you very much, and see you next time. Oh, we have a little survey of questions. If you can answer these just before you leave, that would be great. Thanks, Sharina. Sorry, I forgot about those questions.